As someone who's seen India's journey over decades, you saw Reliance's Growth Fund journey, which was 100x in 22 years. And now your PMS has also grown into being the 8th largest PMS in India with 32,000 crores assets under management. So clearly you are the best person to comment on the India opportunity.
It's been great, and I think we have seen economy evolve. We have seen corporates evolve, from the Lala kind of companies. We have now very, very professionally well-managed companies, focus on return on capital employed, discipline as far as capital allocation is concerned, focus on minority shareholder interest and so on and so forth.
India has had the maximum IPOs globally, right? You've seen the evolution of the IPO market from not having too many IPOs to now being a leader in terms of IPOs.
We always have this view that India grows because of entrepreneurs, and I think these IPOs are encouraging entrepreneurs to grow faster, and it aids in the economy growing and the general well-being because there's so much of employment also which gets added. I think on the flip side, IPOs are being priced beyond perfection. So, we have been very, very careful.
Women, gold and precious metals. What do you think of this commodity cycle?
So I don't understand it, but I always say that women are more intelligent because they keep on buying gold. But I think, gold does well when there are concerns. And I think the world last 4-5 years has been full of concern. And to that extent, gold has been a big benefit.
How do you decide when is the right time to sell?
That's the most difficult question. And some of the names you mentioned, including Bajaj Finance and iShares, I think the regret is that we sold it very early. That will always happen. Equity markets are full of regret. If you don't buy something, you regret if the price goes up. If you buy something, you regret when the price goes down. Same thing, if you sell, you regret because the price goes up. Don't sell and the price goes down, you regret not selling. So regrets are a way of life.
Hello and welcome everyone to the India Opportunity Show. Today, I'm thrilled to have with me Mr. Sunil Singhania on the show. He's one of India's most respected and successful investors. With a career spanning over 30 years, he's built Abakkus into an investment boutique management firm that manages over 40,000 crores assets under management. Before founding Abakkus, he was the Global Head of Equities at Reliance Mutual Fund, where he managed flagship funds such as Reliance Growth Fund that delivered 100x in 22 years. Sunil pioneered alpha generation in small and mid-cap stocks. His MEETS framework for stock selection, management, earnings, events, timing, and structure is widely regarded as the gold standard in fundamental investing. In the recent years, Sunil has also expanded into the private equity side with the launch of 428, which is a PE fund that was launched by Abakkus. He wants to back the next generation of India's winners before they become popular and get listed. His conviction in India's growth story is unshakable, as you'll hear through the interview. And his investment track record reflects a rare optimism for India and its growth story. I hope you enjoy watching. Hi Sunil, good morning. Welcome to the India Opportunity Show.
Thank you for having me.
Thank you for doing this with me. I know it took a couple of months to make this happen. Sunil, I wanted to start with the fact that, as someone who's seen India's journey over decades, you saw Reliance's Growth Fund journey, which was 100x in 22 years. And now your PMS has also grown into being the 8th largest PMS in India with 32,000 crores assets under management. So clearly you are the best person to comment on, the India opportunity. And I wanted to start with how you're thinking about the macro picture today.
No, so I think we are all beneficiaries of what has happened over the last, 2-3 decades as far as India is concerned. And I'm very sure going forward, we are lucky that we still have maybe a decade or two left in our professional life to see the next phase of India's journey. So if you see, we all talk about the Hindu growth rate and how post the mid-90s when the liberalization started, we started to, grow faster and so on and so forth. I think it's been a good, I would say, planned, a journey of not only focusing on, growth as far as the economy is concerned, but inclusiveness, entrepreneurship. And now as we move forward, it's going to be more about technology and the next level of growth and so on and so forth. I think one thing has been very clear. The journey over the last 2-3 decades has been full of events which have been like, binary events where, economy, markets have got impacted. But whoever has stayed positive has been, a beneficiary of what has happened. And I think we would be very lucky that we were also part of that journey over the last 2-3 decades. So it's been great. And I think we have seen economy evolve. We have seen corporates evolve, from the Lala kind of companies. We have now very, very professionally well-managed companies, focus on return on capital employed, discipline as far as capital allocation is concerned, focus on minority shareholder interest and so on and so forth. So it's been like,
Yeah.
a good time, I would say.
Like they say, the optimists always make money in India. But you identified some companies very, very early on, companies like Bajaj Finance, Eicher Motors as well. So what were some of those themes that you identified very early on? I know you have your meets framework. We can talk about that specifically, but what were some of those elements that stood out to you back in the day?
See, what happens typically is that the whole focus from our side has been backing entrepreneurs.
Yeah.
And it does not mean that the company itself is, formed or created by an entrepreneur. It might be from a large industry house, but it is run with an entrepreneurship mindset, with, professional CEOs and all. And I think one thing which we have seen is that what does it take for a company to really become large, or from an investor to really make a lot of money? You should have the size of opportunity on the external side. You should have that passion and the zeal and the vision to make good of that opportunity which exists. And obviously, it's all ultimately passion and honesty, which counts. I think we have been fortunate, entrepreneurs have been fortunate that this country and the investor base has been more than forthcoming in giving all the capital which a good company needs for its growth. And some of the names which you mentioned, they have also used that to grow pretty rapidly. I think one thing which we used to do earlier in our life when I was managing mutual funds at Reliance, look at companies whose market cap at some point of time, that would be the net profit of the company. And I think some of these names which you mentioned have surpassed that barometer, and that's why they have been what they are. So I think consistency, passion, size of opportunity, all that combines, and obviously then you need a lot of luck.
Yeah.
And I would say I have been blessed with good luck over the last few decades. Yeah.
And speaking of luck, I read somewhere in one of your interviews, you mentioned that Madhu Kela hired you in a 5 or 10-minute interview. And you guys, you have famously said that you hunted in a pair, and, you had a very good contrarian thinking mindset, both of you combined, and were able to hunt out really big winners, right? So talk about that working relationship with Madhu Kela, and also how you went about, what was the framework that you developed to be able to go after that contrarian mindset, which wasn't in flavor at that time?
So, every human is blessed with some different characteristics, some of which are positive and some of which might not be that positive. And I think it is good that, you work with people who have slightly different characteristics and positives. Because if people think alike and they work alike, then you don't need 2 or 3 or 5 people. It's the same thing. And I think to that extent, we were blessed. Obviously, Madhu is a great guy, very passionate, very energetic, brings in a lot of, I would say, energy into everything we do. Very good person with relationship capability, very good in terms of trend, thinking and trend sort of forecasting, very good in street smartness.
Yeah.
And I would say I'm more a very traditional investor with focus on fundamentals, balance sheets, and so on and so forth. I think over a period of time, the way I would say a team develops is understanding, the positiveness, as I said, of each other, and working on those trends rather than pointing out what those negatives are. And I think that has been the reason. The other thing is, I think when we joined Reliance, we were 35th out of 35 mutual funds, so small, so irrelevant. No one used to even call us. Brokers used to ignore us. No analyst used to cover us. And we were on a mission to prove something. And I think that zeal and passion also helped, So there was no morning, evening, night. I think if there was an opportunity, we were there, up there, and thought differently. We backed entrepreneurs of even smaller companies when no one was willing to touch them. And as I said, I think ultimately you have to take a call. And some of the calls worked. Obviously, there's a lot of work which went into it. But as I said, we were blessed also with good luck.
Yeah, can you give us some examples? What were some of your fondest memories of investments from?
And I think it's still going on, we're still very close and still talk. And, we have, I am blessed with good colleagues from Reliance days, even here. Most of them are in touch. And I think we continue to to be, I would say the same as we were working together. And memories are so many, it would be not
Some of the
one.
ones that top of
No,
mind
I think
today.
we have gone to visit factories at midnight also. We have basically reached out to promoters who have been so difficult to reach out by very, very different means. I think ultimately it is about understanding what the company has and what the company can do.
Yeah.
And then, then the entrepreneur or the promoter or the management becomes very important, because that is where you have to assess that the size of opportunity is so huge, whether this guy will be in a position to deliver it. And many times when the street is completely negative, that is when the most of the opportunities come in. And if you actually see, very recently, COVID was like a godsend opportunity. Whoever was positive at that point of time was able to, make 10, 20x of what they invested. So I think there you have to have that mindset. So Shrishti, if you are an equity investor, you have to believe that tomorrow is going to be better than today. If you don't believe that, don't be an equity investor. So equity investor has to be positive that the times to come are going to be better than what we are living today and what went by.
Yeah.
And I think if you have that mindset, then you will always be positive and you will be on the lookout for your next opportunity, rather than worrying about whether it's going to be a 5% correction, 10% correction. Even now people talk about tariffs and this and that. I think so many events have happened even in the first 6 months, but ultimately markets are positive.
Yeah.
So if you just remove the noise and just focus on what you know best, which is analyzing the promoter, analyzing the company, and at the same time being optimistic that this 4 trillion is ultimately going to be 8, 10, 20, whatever the economists are projecting, then I think life becomes easier.
Yeah, absolutely. And to your point about removing the noise, I love the Abackus insights that you share, which
Thank you.
is so vivid and so, in just 10 pictures, you are able to convey where we are at in that moment of time, right? What was the inspiration behind it, and what is the process of even selecting what goes on there?
So, when I was in the mutual fund side, we realized that there was so much to read and it was impossible for anyone to read so much. So then what we started doing then, and which we have continued at Backus, it was an initiative which I had, undertaken. We used to curate interesting articles and send every fortnight. And they were very well received because, instead of reading 500,000 pages, you were then cutting it to maybe 80, 90 pages. And then after some point of time, we realized that the attention span is getting narrower. And we started marking the key highlights in those 80, 90 pages, so that instead of reading 80, 90 pages, you whittle it down to maybe 10, 15 pages of actual reading. And that was also loved. And then we realized that attention span is even getting narrower. And that is when this initiative started, where we are sending articles also, but we say that a picture says more than 1,000 words, and that is where this initiative of compiling 10 graphs, with each graph a story in itself. And what we do is we have a large team, almost 20-member investment team. So every fortnight, one analyst is responsible for curating everything. Everyone contributes in a common folder. But that fortnight's editor is a separate analyst, and then obviously I look at it before we send it out. But it's pretty good. And
Yeah.
now going forward, we are trying to add more elements. Maybe use all the new technologies, AI, and also describe in the background, maybe by voice, what is this chart communicating.
Yeah, absolutely. Because in 10 pictures, I'm able to grasp what is happening in that
It's
moment
good
of time.
talking points.
Yes, absolutely. And to your point, there was one which you shared with me recently, which covered, IPO boom in India.
Yeah.
Where India has had the maximum IPOs
Right.
globally, right?
Right.
And that was, even though I am in public markets, that number, when you read,
Sure.
it does stand out, because you've seen the evolution of the IPO market from not to having too many IPOs to now being a leader in
Right.
terms of IPOs. So how are you thinking about this IPO opportunity? Because I know a lot of family offices are very excited about investing in unlisted pre-IPO, which is where you've launched a private equity fund as well. So I'm sure you're able to tap into some of the momentum.
Right,
But
right.
what are you seeing in the space broadly?
So see, every opportunity also brings with it things which you have to be careful about. So yes, you are right. I think a lot of IPOs are coming. On the positive side, it is great because, if companies are able to raise capital, the growth rates will be faster. We always have this view that India grows because of entrepreneurs. And I think these IPOs are encouraging entrepreneurs to grow faster, and it aids in the economy growing and the general well-being because there's so much of employment also which gets added. I think on the flip side, IPOs are being priced beyond perfection. So, we have been very, very careful as far as IPO investments are concerned. I think a lot of good companies, but valuations are like beyond.
They are very steep, I would say.
Yeah. So, one advice would be that just because there's an IPO and there's a gray market premium wherever it comes from, just don't dive into it. We have seen that, majority of IPOs end up below their IPO price in 1-2 years, and we saw that in January and February when the markets corrected. These were the stocks which fell the most. At the same time, I think India is a developing economy, growing economy, new sectors, new entrepreneurs are coming. And to tap them early, obviously IPO is a great medium. So there are huge opportunities also, but one has to be very careful, do your due diligence better. Because in IPO, you don't have a history. See, in the listed space, every company has a history. So you can deep dive 5, 10, 15, 20 years, what has happened in terms of numbers, how they've behaved when the market is good, how they've behaved when the market is not good. But in IPOs, you don't have anything, you know. And no one reads the RHP. That 400, 500 page document has so much data. But I can tell you with a lot of confidence that 99.99% of the investors, including the largest of institutional investors, don't even go through it.
Yeah.
So it's all about what the management comes and guides you, and you are willing to give the benefit of doubt. So we have been very, very careful on the IPOs, and I would urge that everyone else also be quite careful. At the same time, as I said, there will be opportunities of new businesses, some very good entrepreneurs who you would be able to tap at an early stage.
Yeah, and let's talk about this private to public transition more because, personally, it's the most exciting intersection that I am seeing. In my day job as a VC, now seeing companies and startups which have the potential to go public. But you famously go on saying that, we don't back any loss-making companies. So then which are the interesting companies and growth sectors that you are seeing opportunities in, and what are you excited about?
So see, this whole evolution of private and unlisted and pre-IPO started with, obviously, what happened was in 2015, 16, 17, 18, the public markets were not very buoyant. And therefore, the companies who needed capital, they went the unlisted fundraising route.
Yeah.
And they were offering it at a decent valuation. And when those companies came off a listing, which was in 2023, 24 and 25, the public markets were very buoyant. So, you bought it very cheap and you were able to sell it very high. And I think that lure of near-term gains always brings in more and more people into it. There are some startups which have done phenomenally well, and money has gone up by 50, 100, 200 times in the likes of Nykaa and Zomato, and the early investors have made a lot of money there. And I think that also leads a lot of, I would say, not greed, but interest from investors. Obviously, this whole concept of family office has picked up pace last 3-4 years. Entrepreneurs in India, families have huge surplus funds which they are willing to back. And there's this natural tendency to do something different or something exotic. And I think that is also where this whole lure of unlisted or private companies have come in. My view is that yes, there is opportunity, but what happens is that we only remember the ones who have been successful. We don't even talk about, maybe for one very successful startup or a venture backed company which has become 50, 100x, there would be 99% which would have just become zero. We forget that. So I think there is definitely opportunity. There are a lot of entrepreneurs. But few things we have to remember. One is it's a very specialized, I would say investing. So you mentioned about profit-making companies. Our expertise is in analyzing listed companies, and we have a traditional way of analyzing it. So we only back profit-making companies. We are willing to give capital to companies to grow, not to burn. We are very focused on companies as far as their capital efficiency and capital allocation is concerned. So return on capital employed becomes very, very important for us. So I think that is the whole framework in our listed space. What we said is that there's an opportunity on the private side. And family offices and individuals are jumping directly.
Yeah.
They don't have the wherewithal, most of them, to analyze those companies. They don't have the legal framework of having a shareholder agreement and SPA and all done. Can we be the interface and ensure that their capital, which they want to invest in this segment, is invested in a professional way? And that was the logic why we launched a 2,400 crore fund last August. It will focus exactly on what we do in the public markets, which is companies which will get listed over the next 1 to 3 years. Good entrepreneurs, profit making, who need capital to grow in the interim till they become public, and who have decent return ratios. There is opportunity even on the tech side or on startup side, but we are not capable of doing it because we don't have the expertise. Maybe there are some private equity funds who would be in a better position to do it. Again, on the private side, one has to be very careful. On public markets, if you go wrong, there is an exit. On private markets, you will be stuck with it. So, your due diligence process in the private markets has to be more than the public markets. But unfortunately, the investment bankers come and they rattle names that ye invest kar raha hai, wo invest kar raha hai, and everyone piles up. So I think we have to be a little bit careful.
Yeah,
But
definitely. There's so much optionality, and bankers get all sorts of deals
yes.
to you. A lot of them are very, very richly valued that you wouldn't do in the public
So,
markets.
in public or private,
Yeah.
you should know what not to do.
Let's talk about that.
Yeah.
What are the things that you will absolutely avoid or advise people?
So from our side, obviously, richly valued companies which don't justify, the valuation they are asking for, loss-making companies who need capital to burn, not to grow. You just can't, on the basis of a presentation with very lofty future projection and nothing on the ground with no revenue. Those are like, you're just trying to pick a needle in a haystack, because you don't know. Maybe 1 out of 100, 200 companies might become successful. So, you have to be very clear what your risk profile is. If you are willing to basically spray and pray, then it's fine. Then you invest in 100 companies, maybe, 1 or 2 of them might become successful. But I think greed is definitely something which lures, investors to make losses. And the second thing is you should do what you and your style is comfortable with. Just don't do it because someone else or your friend or some marquee investor is doing it. Everyone will have a different risk profile.
Yeah, but I've seen so many people and even bankers come to you and say that, Mr. Sunil Singhania has invested in this deal.
Their perspective might be very different,
Yeah.
right? If a very large investor who has a 10,000 crore net worth invests 10 crore rupees, it's fine, But based on that 10 crore, someone who has 200 crores of net worth cannot invest 10 crores, right? Now, so there is a different perspective to every investor's decision making.
Absolutely. That's a good framework to keep in mind. But also, on the private side, because one in power law and like how it applies to private markets is that, VCs are very comfortable with, 9 out of 10 companies dying as long as they get their one outlier. But in public markets, we are so used to making at least most of the companies win or, betting on their company's growth. We don't want that mortality rate in our portfolio, right? So how do you bridge this balance? Because this is also a mindset balance that you have to bring into the picture.
So as far as our private equity is concerned, we are not giving capital to burn. So mortality is not going to be there.
So you don't expect any mortality?
There won't be any mortality. It is possible that our perspective on the growth of the company might differ a little bit. Some companies might grow faster than what we expect. Some companies might grow slower than what we expect. So our view is that returns might differ. But because we are following a very strict, disciplined approach of backing only established companies, and we are investing 100, 150 crores in one company, so typically that company itself will be worth at least 1,000, 2,000, 3,000 crores. So these are not very teeny mini companies with history of 4, 5, 7, 10 years of operational experience. So I don't think there will be mortality in companies becoming zero. what can happen is some companies might be fantastic in terms of return. Some company might not be what one expected when you invested, So I think we are fine, Obviously, we are very choosy, and that's why we are very slow. So in the last 8-9 months, we have done only 5 investments. But we have already communicated to our investors that we'll invest over 2 years, and we are on track to do it. Now, I think a lot of companies are also appreciating the fact that we bring a lot of value on the table in terms of guiding them, in terms of also, helping them in their journey towards becoming listed. Little bit of, I would say, advantage they get also is that when we invest, there's a normal, I would say, at least a lot of investors have comfort that, someone would have done their work properly. So I think that also helps them. In fact, one of the companies which we invested will go public at 2-3x of our investable price very, very soon. So in 1 year, it will be more than 2-3x of what we invested in. So I think it's working, and we are not in a hurry.
And the risk also on the private side tends to be that sometimes these IPOs get delayed, right?
Yeah.
So we've seen so many companies and promoters talk about getting listed a certain year, and then
you should always be very clear that if a company is expected to get listed in 2 years, it might take 3-4 years. And
is that the framework you entered?
We have a 6.5-year lock-in fund. So we are pretty okay. The other thing is, as long as the business is growing, value is being added.
Yeah.
So whether the IPO comes in 1 year or 3 years, it's only a comfort, Only thing is, if it gets listed, you have an exit option and you can rotate your capital.
Yeah.
If the listing gets delayed, then obviously that possibility of rotating the capital reduces to some extent.
And, I think now we can shift on the public side because you have your meets framework, which you've spoken about very often. But I wanted to make it more accessible to our audience by maybe taking some past examples of companies that you've seen this apply, and maybe even some recent examples where, you've seen in your portfolio that framework has served you well.
So I will explain what we do on the meets framework. I'll dissuade from speaking about any company, past or present. I think I have a journey of 22-23 years of managing public money. And when you manage public money, obviously there is a lot of responsibility because you are in a role of trusteeship. And we've also learned over the last 22-23 years by making mistakes. The only thing is everyone is allowed to make a new mistake. So when we set up a Backus, I think we got together as a group and we said, let us all think about all the mistakes which we have done and analyze them. And after analyzing them, we came to a conclusion that frameworks are always helpful. So let us create a framework which would be sort of a benchmark. It will be like things which we would look to do in terms of our analysis before we enter into any company. A very simple framework. M is management. Now, everyone talks about investing in good management. But how do you come to a conclusion that this management is good? There have been examples of so many companies which are now considered to be excellent management. 5-10 years back, people are not even willing to touch them. So I think the whole concept of good management changes with time. Our view is very clear. Good management is discipline as far as capital allocation and return ratios are concerned. So we don't invest in any company where the ROC, ROE is less than 14-15%. And our view is that if a company keeps on generating a 14-15% return on the capital they're deploying, the ROEs can be upwards of 15-18% also if it's leveraged. And you will, definitely over a period of time generate returns. Second is earnings. See, we are investing in profit-making companies and we are investing on the listed space. How will the value of a stock or a company go up? When the underlying profit goes up. So we only invest in companies where we have visibility of profits of the company doubling, ideally in 4 years, maximum of 5 years. So if the profit doubles in 5 years, the value of the company will automatically double in 5 years, logically, with PE is not going down or PE is not expanding. Second is event trends and disruption. It's become very important. See, we are in a very disruptive world. Earlier, we could buy something for 30-40 years and forget about it. And there have been so many investors who have minted money by just doing nothing.
Holding long
time. I think that has changed because the world is very dynamic. I take the example of newspapers. We are used to reading newspapers. The young guys don't read newspapers. And therefore, if you see the size of Economic Times from 30 to 40 pages have become 12, 16 pages because advertisements have shifted. So with the moat, like once you are used to a particular newspaper, you will read it for life. But still, the P multiples have dropped. Or even TV channels, all our entertainment has shifted to the OTT channels. So all these, the TV channel companies have seen massive fall in their P multiples.
Yeah.
Or even passenger vehicles, despite the glorifying controversies which surrounds, I think Tesla has been the one company which has created wealth, maybe BYD, and all the others like Mercedes and BMW and Stellantis and Volvo and Volkswagen traded 5, 6 PE multiples because there's a threat that technology change might lead to slowdown in growth. So ultimately, what is market price? Market price is equal to EPS into P. EPS is earning. So even if a company has earnings and earnings growth, if the P multiples fall, then you are doomed. And I think that has happened in so many companies.
Yeah.
The T is the timing. We can't time the market, but we do believe in the theory of mean reversion. And there have been so many companies. We came out with an article way back in 2019 when the so-called boom in quality stocks was very, very prevalent. And, we just couldn't buy a company at 70, 80 PE when it was growing at 10%. That means that the PE multiple would have to be 70, 80 times all its life for you to make even 10% return, which has never happened anywhere in the world. Even in US, I think there have been some 5, 7 companies which have traded at PE multiples of more than 50 times or more than 5 years. In India, every second company which was so-called growth and quality was trading at that multiple. So our view is that ultimately valuations have to mimic the future growth. And if you're patient, you will always get that opportunity by the theory of mean reversion to buy your stocks at the right time. And S is structure. We can't deny the fact that we are a young economy. There are a lot of structural plays. There, despite our value-conscious approach, we have to pay a premium.
Yeah.
So I think this meets framework ensures two things. One is we have 6,000 listed companies, 2,500 regularly traded. It's impossible to track every company. But when we run all the companies through these frameworks, we narrow it down to maybe 400, 450 companies. So then there's a focused list. Second is we make less mistakes. It's not that we are not going to make mistakes. We'll make less mistakes because if there's a framework, somewhere, something will, be flagged off. So I think it's worked well. Let's see.
Yeah, I think this is a fantastic framework, by the way. I think
you.
this can serve so many people, even who are first timers in the market. And everyone.
First timers want quick money. This framework is not going to help them make that.
They are doing small and mid caps themselves and doing direct investing, right? But talking about this theme of consistent compounders, because there is a narrative around just hold these quality stocks for 10, 20 years and it will keep compounding. And we
I
often
don't
quote
believe in that.
we often quote Warren Buffett also, and the audience always is talking about Warren Buffett, Charlie Munger. But I want to dive into this contrarian thinking and bring this element out as well, that this whole shift has happened now. And maybe holding long term is not the ideal for your portfolio mix.
No, I would not. I would agree and disagree. You have to have a long term view, but long term you cannot be 20, 30, 40 years now. Because technology and the way you do business is changing. Intel we all use, IBM we all use, but technology has changed so much that they have not been wealth creators.
Yeah.
So I think one has to be up there. And on the other hand, you have companies like Microsoft, which have kept on repurposing them, launching new businesses, and they're still relevant. So I think things have changed. So yes, you have to have a long-term view, but with that long-term view is 20, 30 years, I don't think. And, everyone adores Buffet and Munger, and I also had the privilege of seeing them in their last meeting alive in 2023. But again, I think they were in a very different era. So this worked maybe between 60s, 70s and 10 years ago. Now you have to be up there. If you see the wealth creators now, these are new entrepreneurs, who are working a little differently. I'm not saying that the old companies will not do well, but I think this whole, stability which the earlier companies used to bring has changed completely. You look at consumer companies, you have now Instagram and D2C, and all of us, and more so the young guys, are willing to experiment.
Yeah.
It's not that you're going to have only that brand of soap or shampoo which you're going to use. You're willing to experiment. Clothes are the same thing. It's not that only those 2, 3, 4 brands you're using. So many D2C brands are coming up. You're all using it. So I think you have to be aware of that. And therefore, this whole concept of consistent compounders, yes, it will work, but not from 20, 30 years perspective. Maybe, you'll have to have a long-term view, which will be more 5, 10 years.
Okay. So you hold companies for 5, 10 years
Yeah,
and then
lots.
reevaluate.
In our portfolio, there are so many companies. As long as they're growing, it's fine, But it's not that we are stuck that, we'll hold this for 20, 30 years just because someone has taught us that you have to hold it for 20, 30 years.
And then how do you decide when is the right time to sell?
That's the most difficult question. And some of the names you mentioned, including Bajaj Finance and iShares, I think the regret is that we sold it very early. That will always happen. I think equity markets are full of regret. If you don't buy something, you regret if the price goes up. If you buy something, you regret when the price goes down. Same thing, if you sell, you regret because the price goes up. And when you sell, don't sell and the price goes down, you regret not selling.
Yeah.
So regrets are a way of life. So I think that is going to happen. I think from selling side, 3, 4 things which we keep in mind. One is if the valuations are running much ahead of the best and best things. Best, I would say, scenario analysis, then obviously it makes sense to sell. Second is, which is the most important, if things are not working out the way you know, I think that is where you have to realize, and it's very difficult. Many times, if you have bought something and the price is lower than what you bought, it's very difficult for any investor to sell, whether it's institutional or retail. But the moment you realize that the price fall is not because of external circumstances, but because of the fact that the company is not performing the way one expected it to perform, I think you have to cut. Yeah. Third is capital is limited. To buy something, you'll have to sell something. So if you come across something which is extraordinarily more lucrative than what you already have in the portfolio, it might make sense to churn. So these would be the 3 main reasons of sort of selling off.
Yeah, and also are there any quantifiable factors that you look at, like, PE being one of the most debated?
See, P in isolation might be important, but you also have to look at relative P. So I think only P will not be very relevant. P has to be combined with growth. So I mentioned, 70, 80 P for a company growing at 40, 50% is fine. A 70, 80 P for a company growing at 5, 10% is an issue. So I think you have to combine growth rates, P, moat, future potential, and then you have to come in. So it's not, I would say, straightforward. Otherwise, all mathematicians would be great investors. So, it's a combination of a lot of things, the noise around you, the environment, obviously interest rates are very, very important. I would say the last 3, 4 months markets have been what they are because India has such a huge, I would say the RBI governor has just infused so much liquidity in the system. We have had interest rate cuts. I think it helps the economy, right?
Absolutely. It definitely, any kind of liquidity push does help the economy. But, going back to your theme of regrets, can you talk about some regrets and what's your emotional way of dealing with it now? Now that so that people who are in their 30s, 20s can learn from managing regret better.
No, so I think regrets, I would say, are multiple every day. And
Absolutely.
I gave you the
founder,
regrets.
You have regrets all the time.
You have not bought something and the price moves up. You have bought something and the price is down. You have sold something and the price moves up. You have not sold something and the price moves down. And every day it happens. And every day is a learning. The only thing is, we are in a very dynamic profession where what you do, you get results every minute. Every minute of every day of the year and years and years. And I think to that extent, one has to then start to accept the fact that all you need is to be more right than wrong. You can't be right all the time, And I think that is where I would say experience and maturity helps, So if you get desperate to capture every move up and every move down, you will not be able to capture anything. And I think that is where I would say maturity and experience comes into play. And communication as far as external investors has to be crystal clear because ultimately, if you're dealing with public money, you have to also manage the external expectations and I would say anxiety.
Absolutely, because 30-40% drawdowns in people's portfolios can...
I think the investors have matured a lot, but compared to where they were earlier.
How has that changed? Because you have seen this behavior from your mutual fund days to now running a PMS.
So one is equity investment is become mainstream. So earlier it used to not be mainstream. Investors were investing 2-3% in equity, and they were just focusing a lot on that. So we used to always say that 97-98% of your investments you don't even track on a yearly basis, and this 2-3% in equity you track on a minute by minute basis. That was the thing.
Yeah.
I think investors have matured. Other thing is the other asset classes are not as lucrative as they used to be earlier. So real estate used to make you 15-20%. Fixed income used to give you 12-15% return. Now, those are also giving you 4-5% return. So I think investors are okay with equity giving you, decent double-digit returns. They are not looking at 40-50% return, 30-40% return, which they used to be. Now, we are guiding that maybe next 3-4 years, equities would be more like low to mid-teen. And investors are pretty okay. The other thing is this whole concept of professional family offices have helped. I think all the wealthy guys have kids or themselves who are now well educated. They understand this whole concept of long-term investing. And I think that has actually sunk in. And that is the reason we are seeing whatever the news flow, whether it's India-Pak war or whatever, the SIP investments continue. Investors generally have been pretty much very clear that they want to invest to create wealth over a period of time. And I think that also has helped. And obviously, chats like this, media, I think that has all helped because this awareness of what investing is all about is now more clear. Earlier, equity was all about speculation, satta. But now it is, now investors realize that it is, there's a science and art and hard work which goes into investing.
Yeah, I remember a time where people did call it sattebazi, and they were like, whatever money you put in the stock markets, you burn it, because there was such a negative perception to now this mindset of like long-term wealth creation, which is coming. But you said something very interesting that, you are not seeing that high returns for the next few years, and people are okay with that. Can you educate our audience in terms of why you expect the returns to be lower than what we've seen?
So see, one thing is inflation is bad for the economy, but good for corporate profits. So earlier when you were looking at a 15-18% profit growth, I think 6-7% of that was being contributed by inflation. Because when inflation goes up, your sales growth automatically goes up. So even if you sell the same number of soaps, if the price of the soap goes up by 10%, you'll have a 10% growth. I think that has come down to 2-3%. Second is we are not as cheap as we used to be earlier. Earlier 10-12 P was what most of the stocks used to trade. Now nothing is below 18-20 P. Obviously because interest rates have come down, economy is much more resilient, larger, and therefore, this whole stability has come in. Third is obviously, the alternates like fixed income. As I mentioned earlier, 11-12% was what you could easily make in fixed income. Fixed deposit rates were 9-10%. They have all come down to 4-5-6% post-tax, is 4% in fact. So obviously, if you have one asset class giving you 4-5%, the other asset class, because you're taking that volatility risk, will be slightly higher. It cannot be significantly higher. The last thing is investors are also now looking at post-tax returns. So when you have 35-39% tax on your other income generating investments, and on equity long term is 12.5% with surcharge maybe 14-15%, I think they also take that into account. So post tax, even at 12-15% returns, you are 3x of your fixed income returns. So I think all put together, I think investors have realized as this compounding, even if you grow at 14-15%, your money doubles in 5 years. I think no asset class is going to double your money in 5 years. So I think that there is a big, awareness.
And there's also a boom in gold and precious metals. What do you think of this commodity cycle?
So I don't understand it, but I always say that women are more intelligent because they keep on buying gold.
Already. Indian housewives that ways have been the best.
But I think, gold does well when there are concerns. And I think the world last 4-5 years has been full of concerns. And to that extent, gold has been a big beneficiary. So, you had the crisis in COVID, then you had wars, multiple wars. And I think every time there is some big geopolitical event, gold benefits. Obviously, there is only so much gold which can be produced in a year. And central banks have also been trying to diversify their exposure in terms of forex reserves to some gold. That has also helped. But I think in India, gold did very well because there was a natural 4-5% gain because of dollar strengthening against the rupee. I think going forward, if geopolitical things stabilize, and they're already stabilizing, if you don't hear anything about India, Pakistan, we are not hearing anything in the Middle East concerning Israel and Iran and so on and so forth. I think the only major conflict which is there is Russia and Ukraine.
Yeah.
So if the world starts to become peaceful, then some war premium which is there on gold might reduce. We don't expect rupee to depreciate as much against the dollar, what used to be the trend earlier, maybe 1-2%. So I think to that extent, that also will reduce. But I'm no expert, so
If you're saying that about gold, then I won't even ask you about Bitcoin and crypto.
no,
Any
I
thoughts
have no
around?
idea.
No?
No idea.
You don't spend any time
No,
researching?
because I don't understand it. So, so see, the only reason why someone would buy gold or Bitcoin is praying and hoping that someone else will come and buy it higher from them.
Yeah.
That is the only fundamental logic to it. Gold is not going to give you any dividend. It's not going to give you any interest. So the only way you make money is the price goes up. Mm-hmm. And the same is the case with Bitcoin, because the fundamental aspect, what is there underneath, at least I don't understand.
Yeah, and there's also, we've also been through several narratives such as geographical diversification, right? Where a lot of Indian investors first wanted to invest in the US, but then the US economy in itself, it's debt-ridden, it's going through recessionary fears, and we have a president who can change things at any second. And then, there was also this movement around China and investing in China. But what do you think about that broadly? Because I've always heard you be a big India bull. So what do you think about geographical diversity?
So again, this whole concept of HNIs, ultra HNIs, family offices, you need to be different. So when you are socializing over a glass of wine, कितना अच्छा लगता है ना, मैंने चाइना में इन्वेस्ट किया, मैंने यूएस में इन्वेस्ट किया, you feel good.
It's dinner party conversation.
But how much have you invested? So, no family office of size would even have 1% of their net worth invested outside of India.
That's true.
Now, that is irrelevant. Even if those calls go right, is it going to make too much of a difference to your portfolio? So, there are 3-4 aspects to it. One is we don't understand any country other than India, including US, including China, including Korea, and so on and so forth. Everyone invested in Korea 2-3 years back. They lost money. This year, no one talks about Korea. It's been the best performing market. Same thing happened in NASDAQ. Everyone jumped in 2022 and then it fell by 30-40%. Even now, when the tariff was announced, it fell by 20-30%. Okay, it's come back. But we don't understand. We're just investing because it's fashion to invest in NASDAQ, or it's a fashion to invest in China, or whatever. So I think one is, unless you have a clear view, you should avoid. If you have a clear view, please go ahead. Second is, if you are investing, it should be relevant to your portfolio. If it is 0.5% of your portfolio, 0.1% of your portfolio, even if it gives you 10-15% more return than India, what is going to happen? Third is, India is the fastest growing economy in the world. If it is growing at 7%, I think the world is coming here and we are trying to go overseas. So, yes, it makes sense to diversify, but then diversification has to be relevant. Otherwise, it's no diversification. So, I think at this point of time, because no one is going to invest 10-20% of their net worth outside India, at least I have not met anyone who will invest 10, and you can't because of laws. I think we just advise to keep it simple.
So when you think about diversification, because, for example, people like Ray Dalio talk about investing in uncorrelated assets, or so how do you think about diversification broadly?
But you have here, no? You can have fixed income. If you are a gold lover, you invest in gold. Real estate guys will invest in real estate. There is more than enough diversification. I would say investing overseas would become interesting at some point of time. But I think the only thing we are saying is it has to be relevant from your overall asset allocation.
Yeah.
So I think the day the laws allow us to have 5-10% of your net worth to be invested overseas, then it would make sense to make a serious attempt. Otherwise, say US, if we start analyzing US, we manage 40,000 crores. We will not be able to even invest 500 crores in the US because the laws don't allow us to invest that much. So I think then it's not worth it.
Yeah. The size of the opportunity also
Yeah.
matters.
And
does
even
it?
for the family
Yeah.
or the investor itself,
Yeah, absolutely. And there's also this whole push towards quant investing and algorithmic trading, etc. But what is the case for active fund managers even today? What do you think is the best case for someone like a Backus? Why are people still investing in active fund managers?
So as long as we are able to beat the benchmark, people will invest. So far we have been able to do it. If we stop beating the benchmark, then obviously people will move to passive. The only thing is passive investing to some extent is also dumb investing, and not in a bad way. A company comes in the index after it has done very, very well. And then you are forced to invest whenever it comes. So if you look at Nifty, a Dixon will come after it's already become 1 lakh crore, or Zomato will come after it's already become 2.5, 3 lakh crore. So that is passive investing. Maybe when India matures as an economy, maybe 10, 20 years later, when we are 10, 15 trillion dollar in terms of market cap, maybe that time passive would become more relevant. But right now, I think most good active fund managers are able to beat the index over a period of time.
So what is your return that you aim for on a yearly basis?
As I said, going forward, we are guiding for low to mid-teen returns, and that is largely because our investee companies in the portfolios should have a profit growth of that much. So we are not banking on any P multiple re-rating. We are banking on the fact that whatever is the profit growth of the underlying company at a portfolio level, that kind of return we should expect.
And Sunil, I've also heard you say that you back companies which are cyclical in nature as well. You don't shy away from those kind of investments, whereas a lot of people wouldn't touch those kind of investments, right? So what is the thinking that drives you towards these kind of businesses?
So, obviously, if you look at cyclical businesses, deep cyclicals like metals, we also have a risk metrics where we don't go beyond single digits allocation to them. But our view is, multifold. One is, I think Indian metal companies are among the lowest cost producers in their respective segments in the world. Second is, this is a cyclical business in terms of prices, not cyclical in terms of demand. Demand continues to grow.
Yeah.
Third, obviously, is that if you have your metrics right in terms of return ratios, so there are decent companies, even in these cyclical sectors, which have good ROC, ROE over a block of period. You can't say that this year and next year and so on and so forth. And experience over the last 20, 25 years of experience in these companies have been pretty good. So there is no reason why you should not do it,
Yeah.
So I think that is where we are.
And without taking names, I know that even Pharma looks interesting to you, despite what's going on with the tariffs in this sector. Why are you bullish in Pharma?
So one is, I think pharma, Indian pharma companies have an inherent edge. This is a sector which is, I would say, knowledge-based, and where we don't compete with China other than in the commodity plays of generics or APIs to some extent. So it is knowledge-based. Second is, I think Indian pharma companies have been now very, very innovative. And this whole opportunity of research, we saw one big molecule, billions and billions of dollars being given only because it was successful. The whole CDMO space, obviously innovative drugs. I think that is all picking up. On the tariff front, we don't see major issues because, if you see, whenever a drug is launched by Indian pharma companies in the US, prices fall by 95%. So the beneficiary of that is US insurance companies and the people of US. Even if you put a 20% tariff, instead of 95% saving, you'll have 94% saving, because 5% by 20 is 6%. So you still have 94% saving. So I don't see tariff being too much of an issue. And stocks are not very expensive. In fact, if you look at the consumer pack and then you look at pharma companies are growing as much or maybe faster than the consumer pack with a lower valuation and more entry barriers.
Yeah,
you can't sell a product on D2C on Instagram or something,
Yeah.
You can sell a soap or a piece of clothing or, shoes on D2C. People will be willing to experiment. On medicines, you're not going to experiment.
Yeah, because recently when I was looking at pharma companies, I looked at the P's there. They are mostly sub 25, 20,
Yeah, they're
30
very reasonable
kind of.
and
Yeah.
growth is pretty decent.
Yeah. And the numbers there also look quite attractive. Any other sectors like that you think are undiscovered or underappreciated
So,
today?
see, when I started my career as a buy-side professional, there were very few analysts who used to look at balance sheets and fundamentals and so on and so forth. Now, everyone does it. So, nothing is undiscovered. I think it's all about now taking a view which is slightly differentiated. The only good thing is that India is a country of entrepreneurs, and there are so many listed companies. And all we need to do is find 5, 7 good companies in a year. You don't need to find 500 companies, right? You just need to find 5, 7, 10 good companies and back them. I think across sectors, you keep on getting opportunity. You mentioned about cyclicals like metals, you end up getting something. NBFCs was hated. Now this year NBFCs have done well. So I think you have to take a call which might give you pain in 1 or 2 years because the price is not moving. But as I said, as long as the fundamentals are trending in line with what an investor is expecting, I think will ultimately make a return. So we just need a few companies, and there are more than enough entrepreneurs in India who would be willing to give us that opportunity.
Yeah, like to your point, I think financials were badly beaten down last year, but what a comeback they've
Right.
had. And then also renewable, I heard you say that you're bullish about. What are some of the factors that you think about there?
I think renewable companies is one thing, but renewable as a segment is the best thing to happen to India as a country.
Absolutely.
We import so much energy, like fossil-based energy, like crude and coal and so many other things. I think renewable has just the potential to transform India significantly. We are already overshooting our targets of, putting up new solar and wind power. I think solar, because it is easier and faster to put, has a long runway, maybe for the next 5, 10 years. But imagine if 30, 40, 50% of our energy requirement over a period of time would be met by renewable. And more so because now you have battery prices which have collapsed. So you have this whole battery storage, which can make renewable power also, I would say, more, reliable in the sense that you can get when you want it because the energy will be stored. I think that can be the best thing to happen to India. Already a crude is at $68, $69, and this is despite all the geopolitical concerns which has been plaguing the world over the last 1, 2 years. If oil stays even at these levels or falls to $50, $60, I think India would be the biggest beneficiary of it. So companies apart, I think this whole move towards renewable is the best thing to happen to India as an economy.
Yeah, and do you think we have enough going on in the renewable space to be able to power through the AI and data centers? Because there's so much energy requirement which is also coming.
The best thing is in India, if you allow 1 or 2 companies to become multi-billion companies, then you have hundreds and hundreds of entrepreneurs who get into it, which is the best thing to happen. I remember Jindal Steel and Power we used to own in Reliance, that 1000 megawatt power plant which they put up in 2006 for 4,000 crores, gave them 4,000 crores of profit for 2 years.
Wow.
And it was good because people and other companies looked at that profitability, and we had 50, 100 gigawatts of power set up by private companies. If that would have not happened, India would have had a massive crisis of power. I think the same thing is happening on the solar side. You have 2, 3 large solar companies which you have got listed like Wari and Premier and so on and so forth. Now you have like 100 gigawatts of module capacity coming up, 50, 60 gigawatts of cell capacity coming up, which is the best thing to happen. Because seeing their market cap and seeing their profit, there have been so many entrepreneurs who are coming in. So I think somewhere this capitalism works and helps because it leads to a mega investment which happens in that. And I think once you have that, then we will have more than enough capacity across segments which will be more than enough to take care of all our energy needs. Yeah.
Yeah, and since we can't take any names, I know that in the Backus portfolio, there have been several companies which have, become 10x opportunities in 5 years or so, right? Are there any opportunities that you're excited about now in the sense of do you see any sectors with that kind of return potential?
See, that we come to know only
in hindsight.
So I think last 1 year has been tough, frankly, for multiple reasons. One, growth generally has been slow. Corporate profit growth has also been very, very slow. Second, external events have been very binary, so they keep on scaring and causing a lot of disruption. Like this whole tariff thing over the last 2-3 months, there's a massive issue of demand for suppliers, particularly to the US, because of uncertainty. You don't know when the goods reach there, what would be the tariff. Third is, valuations have not been very cheap. So I think when you invest, you don't know whether this company is going to be 5x or 10x, but you have I would say a framework which gives you confidence that, okay, in 3, 4, 5 years, this company can double its profits and so on and so forth. And then when you have the external, I would say, tailwind, which, follows this, that is when you have, I would say, not multi-bagger, but disproportionate return. So how will you have a disproportionate return? As I said, market price is equal to EPS into PE. If both EPS and PE go up, that is when you will have a disproportionate return. So I think that can happen only if the growth in the company in terms of the size, the revenue, the profit is high. And second is, you have not bought it very expensive, so you have bought it when no one was looking at it. And now when people will start to look at it, the PE multiple also will go up. Yeah. But it's very difficult. It's only, as I said, going into the future, you'll know what you thought would be disproportionate return companies, whether they actually became one or not.
Yeah, and just my last question, because as someone who's seen the markets for 30 years almost, what are some of the things that you will leave the audience with that they can actually tactically apply in their lives, in their mindset to become better investors?
I think the good thing is now, because of content available so easily and freely, multiple interviews of all the experts are there. I think the good thing is when I meet young professionals, they are much more knowledgeable and aware than we were at their age. So I think they already know a lot. The only thing is, every investor will have to find his or her bearing and his or her strengths and weakness. Because you are interviewing me, I gave you my perspective. You go to some other investor, that other investor will have some other perspective. So every investor has a different perspective, and that's how the markets are made, right? A trade happens because there's a buyer and seller. The buyer believes that the price is going to go up. The seller is believing that the price is going to go down. That's how the trade happens. So every investor will have a different perspective. You can't copy all, because then it will become a khichdi. And you will end up making nifty returns, because you will end up having 100 stocks because every So I think from an investor perspective, first they have to find their bearing, which will come over a period of time, that what are they comfortable with in terms of their investment style, and then work towards it. Some would be very good in trends, some would be very good in trading, some would be very good in buying and forgetting. So I think every investor will find his or her I would say, style of investing over a period of time.
Thank you so much, Sunil, for taking out the time
Thank
to
you.
be here today. I think you're the perfect example of the India opportunity in embodiment, because you've lived through this cycle and there's so much more you're excited about. So all the best to you.
No, thanks to all your investors, and Jai Hind.
It's not every day that you get to sit across from your icon and ask them all the questions that you wanted answers to. And that was the day for me today. If you enjoyed watching this episode, please remember to subscribe to our channel so that you get notifications every time we drop another one.